Good morning, Venture Capital. This is Metagame, and today's episode is about how the Golden State is warping the entire investment universe, pulling deals into its orbit as California's explosive expansion reshapes where and how venture money flows across the industry. 636 deals, $173.8 billion, one state. And if you're sitting there thinking, yeah, California, we know, you don't. Because while you were watching San Francisco do San Francisco things, Los Angeles just pulled off one of the most aggressive capital grabs in venture history, and nobody's talking about it. Here's what happened. California didn't just maintain dominance this quarter, it accelerated. Deal count surged 11.4% while deploying nearly $174 billion. That's not recovery. That's a victory lap while the rest of the country is still tying its shoes. But the headline number is hiding something far more interesting. A geographic redistribution is happening beneath the surface, and it's reshaping where the smart money is actually flowing. Let's start with the obvious, San Francisco. 144 deals, $46.7 billion. Deal growth up 19%. The city is doing exactly what you'd expect, capturing the AI infrastructure mega rounds that are defining this vintage. Cerebras closes a $1 billion series, H at a $23 billion valuation. Beseton raises $300 million at $5 billion for AI inference, XAI, Databricks, Grammarly, Ripple, all SF, all writing checks that would have been entire fund sizes 5 years ago. San Francisco isn't just leading, it's pulling away. Its 19% deal growth outpaces California's 11.4% average, which means SF is capturing disproportionate share even within a state that's already capturing everything. The average deal size? $324 million. That's not seed rounds and Series A's. That's late-stage capital formation at industrial scale. But here's where it gets interesting. Los Angeles, 91 deals, $46.5 billion. Deal count up 62.5%. Read that again. LA's deal count surged 62.5%. That's not growth. That's a structural shift in where capital is flowing. And the dollar amount? $46.5 billion, essentially matching San Francisco on half the deals. Do the math. LA's average deal size is $511 million. That exceeds SF's $324 million. LA is writing fewer checks, but each one is significantly larger. Classic late-stage growth behavior, but in a market everyone dismissed as entertainment apps and influencer brands. What's actually happening in LA? Aerospace, defense tech, industrial AI, Beta Technologies building eVTOL autonomy, Stoke Space doing reusable rockets, Castilian raising $360 million for defense manufacturing. This isn't consumer, it's hardware-centric, sovereignty-first platforms that can't touch public cloud because half their customers have security clearances. The LA surge isn't random variance. It's a response to enterprise AI repatriation. 93% of enterprises are now moving AI workloads back on premises or hybrid. That shift favors exactly the categories LA specializes in: Edge AI, hardware infrastructure, classified workload, ready platforms. LA offers non-correlated exposure to SF's software monoculture, and growth funds are pricing that diversification into their deployment. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. Now here's the cautionary tale. Menlo Park. 26 deals, $19.8 billion. Deal count down 33.3%. A one-third contraction in deal count while still deploying nearly $20 billion. That's extreme concentration, a handful of mega rounds carrying the entire geography. Genesis Cloud filed twice for $1.5 billion each. Makina Capital anchored a $13 billion pooled fund, but the deal velocity collapsed. What does negative 33% deal growth actually mean? Either traditional sandhill firms are rotating capital toward SF operational hubs, or Menlo Park companies are relocating to San Francisco for talent density, or new fund formation is happening outside the old guard zip code. Probably all three. Menlo Park isn't dying, it's consolidating. Too few companies capturing too much capital with insufficient pipeline regeneration. If you're exclusively anchored there, you're facing deal flow contraction and valuation compression. Fewer deals means more competition for the same assets, which means paying premium prices for scarce opportunities. That's not a strategy, that's a trap. So let's step back and look at what California's $173.8 billion actually represents. Roughly 86% of the entire U.S. venture market. That's not a regional preference. That's gravitational physics. AI talent clusters in the Bay Area. So AI companies form there. So AI-focused funds concentrate there. So AI exits happen there. Self-reinforcing gravity that gets stronger the longer it runs. San Francisco alone likely deployed $30 billion or more into pure AI and machine learning investment. That makes it the single densest AI capital market globally, surpassing Beijing's Zhongguancun, surpassing London's tech corridor, surpassing everywhere. The SEC filings in other technology tell the story. xAI at $5.3 billion, Databricks at $5.7 billion cumulative, Synopsys at $2 billion, Verkada, Ramp, Grammarly. These aren't consumer apps. They're infrastructure, enterprise SaaS, AI platforms, and hardware. The picks and shovels of the AI build-out that will sustain California's capital attraction long after the hype cycle moves on. And that enterprise repatriation trend, it's not contradicting the cloud-first experimentation of 2023 and 2024. It's the maturation of it. Early cloud experiments are shifting to cost-optimized, sovereignty-compliant, latency-sensitive production deployments. That shift directly benefits California's AI infrastructure stack. On-prem inference, GPU efficiency, hybrid orchestration, security at the edge. The 93% repatriation statistic isn't a warning about cloud failure. It's a green light for the next wave of infrastructure investment. And California owns that stack. So what does this mean for competitive positioning? First question, are you geographically diversified within California or over-indexed to a single city? The spread between SF's plus 19, LA's plus 62, and Menlo Park's minus 33 implies intrastate rotation risk. California exposure requires city-level strategy, not state-level blunt instrument. Second question, how are you positioned for the AI infrastructure extension cycle through 2028? If your portfolio skews toward cloud-native centralized AI, you may be early cycle positioned in a mid-cycle market. Late-stage growth funds are writing $300 million to billion-dollar checks into infrastructure, compressing returns for earlier-stage funds that can't follow on at scale. Third question, what's your LA thesis? Because if you don't have one, you're about to watch Sequoia and A16Z and Founders Fund establish positions while you're still debating whether aerospace counts as tech. The 62.5% growth is your early warning signal. The window is closing, and here's the risk of ignoring all of this. If California's $173.8 billion represents 86% of U.S. venture deployment, then non-California funds are competing for 14% of capital formation. Even if you win your local market, Austin, Boston, Miami, you're capped at a fraction of the action. Your portfolio companies will still need to relocate to SF or LA for Series B capital access, creating adverse selection where you fund the seed, they move, and you get diluted by coastal growth funds. The geographic concentration risk isn't California failing. It's California succeeding so decisively that non-California strategies become structurally disadvantaged. There's one more angle worth noting. Menlo Park's 33% contraction creates talent arbitrage. Experienced investors and operators exiting legacy Sand Hill firms are available for new fund formation or strategic hires. But they'll re-anchor in SF or LA, not Menlo Park. If you're raising a new fund or scaling a platform, this is the window to recruit Sand Hill talent before they re-syndicate into competitor platforms.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
So let's come back to where we started. 636 deals. $173.8 billion, one state. But it's not one story, it's three. San Francisco, the AI infrastructure capital of the world, pulling away at 19% growth, capturing the mega rounds that define this vintage. Los Angeles, the stealth winner, up 62.5%, matching SF's dollars on half the deals, building the aerospace and defense tech and industrial AI stack that enterprise repatriation demands. Menlo Park, the cautionary tale, down 33% in deal count, concentrating into fewer and larger bets while the pipeline thins. California isn't just the leader in venture capital, it is the venture capital market with a rounding error called everywhere else. The question isn't whether you believe that, the question is whether your portfolio construction reflects it. That's our venture capital podcast for today. If you learned something new, Tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.